Hi and welcome to our weekly buy-to-let mortgage market update. I hope you're all keeping really well. It's Wednesday morning, it is raining here and I feel like we're almost in autumn rather than the height of British summer. Standard, I suppose. So in terms of what we have been seeing on the lender side of things this week, first of all, the Ipswich Building Society has announced that it is withdrawing all of its buy-to-let products, including their expat range and their holiday let range. Now their rationale for doing so, their reason for doing this, is really driven by the sheer volume of inquiries that they've had in over the recent weeks and their service standards slipping. So what they've done is they've just put a pause on new applications for now to give them some breathing space to handle the inquiries they've got on their desks. So a pause from them rather than a total withdrawal from the market, and we hope to have them back really soon. The Newcastle has relaunched its buy-to-let offering at 75% loan to value, and we've seen Kent Reliance and Precise do a reprice on their products with a slight increase. Now, Foundation Home Loans have relaunched some what they're classing as pre-COVID buy-to-let products, which is really good news. So what we're seeing is that they've come back to the market with a large loan product, early remortgaging, so if you want to remortgage within the first 6 months of owning the property, and also a short-term let product, so essentially a holiday let product. They've also introduced a number of rate reductions across their product set of up to 40 basis points on their 5-year fixed products. And this is for both individuals and limited companies. And they've now got rates starting from 3.29%. Lastly, on lender news this week, the Monmouthshire Building Society has re-entered the holiday let market, adding a range of products for both individuals and limited companies. Now, the range allows the mortgage holder to let their property through a variety of avenues, and this includes Airbnb. And we're going to talk a bit more about the holiday let market in a moment, actually, because it's really hotting up. But that's the lender news for this week. Moving on to the housing market now. So the latest data released by Halifax has revealed that in June there was a slight dip in house prices of 0.1% as the UK property market eased out of lockdown and resumed operations. The average house price now sits at £216,403, which is down from £218,902 in May, and that's according to the Nationwide House Price Index. However, please note that the average house price still remains 2.5% higher than it did this time last year. Now, Good Lord have released some data with regards to the rental market, saying that the lettings market activity throughout June was significantly higher than recorded at the same time last year. And as a result, rental costs are rising in the majority of regions and void periods are reducing. So the average cost of rent has risen by an average of 3% across the 8 regions which Good Lord monitors. The biggest rise was seen in the southwest, which saw average prices increase by 11%, so up to £965 from £859. Wales has followed closely with a 9% rise in average rental costs, and the only region reported to see a dip in rental prices was the East Midlands, which dropped down to £795 from £825 per month. Now, what they've said is the UK average rental cost per property now stands at £892.72, up from £862.48 in May, and void periods dropped in 5 out of the 8 regions they monitored. So really good news for landlords, and really just demonstrating that the demand for rental properties is holding really firm. There is some school of thought which says that as the economic uncertainty continues, it will lead to a reluctance for people to purchase homes going forwards, and thus lead to an increased demand for private rental property. At the moment, we're not necessarily seeing that as the housing market goes through a bit of a bounce on the back of the release of lockdown. But actually in the longer term and later into this year, as the furlough scheme comes to an end and things might get slightly more tricky, we could certainly see the housing market calm down and the rental market really kind of benefit, I guess, on the back of that. Also in the property market, after another government announcement around the reopening of the hospitality sector in England from 4th July, holiday bookings across the UK are reported to have risen significantly, with coastal counties and holiday destinations such as Devon and Cornwall seeing notable surges. Now, I really like this bit of data. So Host Seasons and Cottages.com, which are 2 of the largest self-catered holiday accommodation providers in the UK, were said to have recently seen their best online sales days, with the former seeing a booking every 11 seconds and the latter seeing a 455% surge. Sykes Holiday Cottages saw similar growth, with 417% booking growth over the past month and a 221% growth compared to the previous June. And what we were seeing really is that these figures demonstrate the demand for people wanting a post-lockdown holiday, but for those who either can't afford to travel overseas at the moment or simply don't want to and would prefer to stay in the UK. So this really just reports back to our kind of predictions that the holiday letting market is going to go through a real boom period, which we expect will last at least a couple of years. And we're seeing lenders reopen their doors to holiday let applications as well, as I mentioned earlier on. So really everything's kind of coming together quite nicely to support this part of the market for those landlords who are looking to invest in the holiday let sector and make the most of this opportunity that's in front of them. Also within the last week, Lord Greenhow, a minister at the Ministry for Housing, Communities and Local Government, has confirmed that from the 24th of August, the courts will begin to process possession cases again, which is obviously great news for our landlords who are having problems with their tenants. There is a concern, however, that there are some 62,000 business as usual repossessions backlogged at the moment. So it could be that if you have a case that needs to go before the courts, there could be some delay until you get to be heard. Now today is Wednesday, it's around 7:30 in the morning, and we have Rishi Sunak doing his summer statement, which we're looking forward to immensely, because I'm sure you would have heard there is rumours around, rife in fact, that there is a proposed stamp duty holiday on the cards. Now, if the rumours are to be believed, it's properties up to £500,000 that would be exempt from stamp duty for a period of 6 months going forwards. Now, as soon as the rumour mill got going on this, our phones started ringing off the hook with clients with lots of questions, and they're all really good questions and very valid. The first one was, when will this kick in? Now, obviously we don't have any of the answers because there's been no formal statement as the point that I'm recording this video. What I can tell you is that when we had a stamp duty holiday after the credit crisis, it clicked in very, very quickly. So there is a concern that if Rishi Sunak announces the stamp duty holiday and it's not going to start until the autumn, the housing market will essentially grind to a halt until that point. So it's not in anyone's interest for them to kind of delay the start of this. If they're going to do it, they're going to need to do it quickly. So I suspect that actually this will come into play, in the next few days, which is fantastic news. Other questions we're being asked are, for example, is it only properties up to £500,000 that would be exempt, or actually is it properties over £500,000? So say you're buying a property for £1 million, is it only the first £500,000 that would be exempt from the stamp duty? My suspicion is that it will be only properties valued up to £500,000 that will be benefiting from the stamp duty holiday, I'm afraid. And the last question we're being asked a lot, which obviously, is really valid for our audience here, is for buy-to-let properties, will it be a total stamp duty holiday? Will it be just on the normal rate of stamp duty and then the surcharge would still be payable? And I suspect actually it will be the latter. So there'll be a stamp duty holiday for the normal rate of tax, but the surcharge would still apply for buy-to-lets and second homes. But we'll wait to see, and we'll deliver more information on this as soon as we have it, because obviously this is very, very important to our clients. Now, interestingly, on the back of this news coming to light, Zoopla have reported, and I just found this really interesting actually, that if this proposals go ahead as people suspect they will, it would mean an additional 73% of sales would be exempt from the basic level of stamp duty. They say that added to the present figure of 16% of sales falling under the current £125,000 purchase price band, this would mean that 89% were exempt in total for the 6-month period being suggested. Excuse me, the policy would extend a stamp duty saving of up to £14,999 for a home purchase for non-first time buyers, and an overall saving of around £1.3 billion across the 6 months. So really, you know, obviously there's more news to follow, but obviously, you know, from our perspective, this can only be a positive thing, which will help underpin the housing market. There is some concerns that actually it's kind of a bullet, it's a sticking plaster, it fixes things for a short period of time. It will push activity very aggressively for 6 months. Thereafter, there's going to be a massive lull. But I think personally my view is that actually anything that will help kind of support the housing economy or housing market, which is so important to the wider economy, can only be a really good thing. Lastly for today, and to end our video on a high, some news on the economy. So manufacturing activity grew in June, prompting hope that the UK may see a V-shaped economic recovery following the hit from the coronavirus pandemic. The IHS market slash CIPS manufacturing PMI, where scores below 50 show decline and above 50 show growth, rose from 40.7 in May to 50.1 in June. And really what they're saying is that manufacturing is therefore leading the economic recovery. In addition to this, and ahead of restaurants, pubs and other businesses being allowed to reopen, a range of real-time data suggested that the UK economy is beginning to regain momentum. And the latest survey by GfK showed that consumer confidence had increased to -27, a small increase after the index fell to its lowest ever level of -36 at the start of June. Meanwhile, Jeffreys, which indexes data on public transport use, electricity consumption and flights to measure economic activity, have found that while activity is still at only 52% of its pre-lockdown level, there has been a noticeable increase in the past week. So yeah, we're going to end this week's video on that note, but obviously, you know, any good news is really welcome at the moment. And it does certainly feel from where I'm sitting that things are moving in a positive direction. And hopefully once the furloughing rules change in August, actually the knock-on effect won't be quite as serious as some have predicted. We are certainly seeing some adjustments in terms of people's predictions for the economy going forwards, as people have monitored what's been happening around the world, particularly in the United States, with re-employment doing much better than people had hoped. So yeah, that's it from me this week. As always, please do give us a call if you want to have a chat about anything mortgage related. Our consultants are there and ready to take your call, 0345 345 6788, or go and have a nosy around on our website, mortgagesforbusiness.co.uk. Yeah, and I'll see you next week. Hopefully the weather will have brightened up. I do feel it's like autumn today. I wish it was autumn. That would mean that my son was back at school and we would have to be homeschooling, which would be quite nice. But I'll see you soon and look after yourselves.